Back to Australia's annual rate of inflation, it jumped 7.8% in the December quarter, the highest increase in almost 33 years. Joining us live now, Westpac's chief economist, Bill Evans. Bill, good morning to you. So thanks for your time. What did you make of yesterday's numbers?
Well, they were higher than expected, Pete. The market was expecting 7.5. It printed 7.8. And the underlying number that the Reserve Bank follows most closely, they were predicting 6.5, and it printed 6.9. So the pressures were stronger than had been expected. And the more worrying issue was that it's switching now to services. So services inflation that was only running at 3% 6 months ago, now running at 5.5%. And that, of course, is reflecting strong services increases in travel, accommodation, restaurants, etc.
Do you think these numbers point to policy failures?
No, look, I think the economy is just coming out of COVID is just an extraordinarily difficult period. We've seen these extraordinary legacies from that. The fact that people have been saving so much money and they're now wanting to spend, the reopening effect, the fact that we have incredibly tight labour markets. So it's all a function of very strong spending, but unfortunately the spillover is high inflation.
Yeah, I mean, and you're also got December, people are spending a lot more money at Christmas, which is what they always do. So in that sense, is it not that surprising?
Yes, but it's just much stronger than in previous years.
Right.
And what we've seen is that businesses that have been responding to these higher prices and costs are finally feeling confident enough to raise their prices. And that's a process that is worrying, and that's the one that the central bank will really have to keep an eye on in the course of this year, this change in psychology.
So what sort of unpopular policy decisions, are going to be needed?
Well, the Reserve Bank will have to keep raising interest rates. We expect them to raise the cash rate by 25 basis points in February and then another one in March. And we actually think that there'll have to be a final hike in May. And that's been our view for a very, very long time. And even with those numbers, we don't expect to see a recession. So a lot of this scaremongering that we're seeing, that if they raise rates once more, Australia will tumble into a recession, I don't think that's really justified in terms of the outlook.
Okay, 3 rate rises, though, over the next 4 to 5 months. That's going to have an impact, though, on mortgage owners, isn't it? A significant impact.
Absolutely, but you have to remember that most of the hiking cycle is behind us. It started in May last year, and we had every month we had a rate hike between May and December with a number of 50 basis point movements in there. So the accumulation of those hikes is working its way through at the moment, and the fact that we see a few more that the Reserve Bank will have to do, given the performance of inflation, I don't think people should become too scared about what's going to happen in the future. It's really looking back on what has already happened.
What would you expect that to do to the housing market?
Well, we've already seen the housing market unravelling. House prices down around 8% from the peak, and Sydney, of course, has suffered a lot more than that. We're starting to see house price falls moderating now. It looks as if the peak at which prices were falling, say in the September quarter, Sydney 6%, the December quarter only 2%, that's starting to moderate. I would not expect that with these rate hikes that we're now expecting, that many people were anticipating anyway, I wouldn't expect that to create a shock horror in the housing market. I think the market will continue to peel off, but at a slower pace.
Okay, well, Bill Evans, folks, he is as good as it gets when it comes to economists, so we can expect 3 rate rises but no recession, so we can calm that talk. Bill, appreciate your time as always. Thank you so much. We'll talk to you again soon.